Now our favorite topic of Asia and China, and this, I shouldn't be mean but this is one of my favorite segments, is talking about what's happening in Asia, what's happening in China, and the reason why is because there's such a mixture of absolute opportunity and how this market could collapse. And I think that the difference between the two is fascinating. I love it. And it's just a great example of how you can be in a bull market and a bear market at the same exact time, which is always fun. But now just looking at China, because it's important to now remember they have a zero tolerance COVID strategy. So this is why what we're about to talk about is important. So over the past week, domestic COVID-19 infections have been on the rise. 500 new domestically transmitted symptomatic infections, up from 370. 164 new domestically transmitted asymptomatic infections, up from 38. So that's the bigger issue for them, is now they're getting more and more asymptomatic individuals, which makes it harder to track because they're still infectious, but they don't know they are, and then they don't know that they're spreading it, which becomes a bigger problem. So this round of COVID outbreaks started right after the October week-long holiday and has only continued to grow, with multiple infections spread countrywide. As of last Friday, this round of COVID has spread to 44 cities and 20 provinces, and local governments are trying to obviously create that containment. But on Saturday, a health commission shut down any talk of relaxation, because this has become kind of that back and forth of how much is relaxed. And we must uphold a policy of preventing the virus from re-entering the country to cause a new epidemic. We must stamp out an infection whenever one arises. So again, that's just not going to see any type of adjustment to that policy in the near term. Many stuck inside and outside China have been hoping that China might relax that policy ahead as there's an approach to the Beijing Olympics, but there is no indication that that's going to happen as they try to keep this clear ahead of the Olympics that kicks off in February. So now there's some news bouncing around based on is Evergrande in default? Are they not in default? So let's go through the series of events that have happened so far. So the first headline is China Evergrande Group today again defaulted on interest payments to international investors, so these bonds have not received any interest payments until they have until today's end for the grace period, and they're preparing bankruptcy proceedings. That was about 3 hours ago, so it's 3:50 right now. That came at about 12:31. Now, China Evergrande Group, the second largest real estate developer, defaulted on interest payments on two bonds back in September, with the 30-day grace period expiring today. However, shortly before the end of the grace period, the public was misled by rumors about alleged interest payments. The international media also took the rumors for granted. So when you look at it, already recognized the default at the time and proved in the study, the world's most indebted corporation could ultimately lead to a great reset. So that's the newest. Going from there, customers of international clearing firm Clearstream received overdue interest payments on 3 US dollar bonds issued by Evergrande. So right now that means that 2 investors that hold 2 of the bonds confirmed that they received the payments. So you're starting to see that, okay, well, they were going to default. They didn't default. There was a view that they paid 2 out of the 3, but now it appears that they paid 3. So what was due? Investors have been waiting to see if the embattled developer would make the coupon payment totaling $141.1 million before the end of the 30-day grace period on Wednesday. Evergrande missed the original. The affected bonds, a 9.5% note due 2020, 10% bond due 23, and a 10.5% note due 2024. So that's what. So far they're back in compliance. They met their grace period, but it's not over, and there's more to come when you look at where these pressure points are residing. So now let's look at a quick update on the Chinese data. So foreign reserves ticked back up. They were expected to be at 3.2 trillion. They came in at 3.217. Exports surprised to the upside. They were expected to be at 17.1%. Came in at 20.3%. But now that was good. That was we expected to see that surge, because remember the Golden Week is the first week of October. So September, you had issues in terms of ports, but you had that surge into the end of September to get ahead of Golden Week. And then typically you get a surge after Golden Week to catch up with what you missed on the first week of October. But imports is where you get that issue. Because imports were expected to be up to 20.4%. Instead, they were up 14.5%. So that it has two indications. One, you have imports coming down, which means that the local individual is buying less, and you're going to have less throughput. So remember when we talked about, and this is just coming to fruition, when we said the leading indicators had China buying less goods in the international market, and we said that was going to result in less imports, and that's it playing out right here, which is going to mean that there's going to be less exports, and which, based on the leading indicators, there's new export orders are down. They're down below 50. They're in contraction, so that makes sense. Now, the trade balance was up because of it, but CPI, and we talked about this last week, we're starting to see companies internally increase local prices because they have no choice. They are sitting at the highest rate of inflation ever, or at least going back to the 90s, and they need to pass it on somehow. So it's still small, but last month it was 0.7. It was expected to be at 1.4%. It came in at 1.5%. And then PPI just exploded to the upside. It was expected at 12.3%, came in at 13.5. But remember, it was at 10.7% last month. So you're up 3.5, almost 3.5% on top of that. Again, that is the underlying issue that we're seeing. Aggregate financing dropped, was expected to be at 1.7 trillion yuan, came in at 1.59. New yuan loans, though, increased by 26 billion. And then when you look at money supply, you're starting to see a little bit of a creep higher. But again, it's just that manage into year end, into month end. And it's just trying to stabilize the credit impulses, not really getting it up, but not bringing it back down, just kind of getting it right in this fixed level. So China's central bank says end of October outstanding mortgage loans rose 348.1 billion yuan month over month to 37.7 trillion yuan versus an increase of 246.8 billion end of September. Data shows that growth in China's outstanding mortgage loans accelerated in October, and it's a rare move for the PBOC to specifically mention outstanding mortgage loans amount on its official Weibo account, probably intending to signal later policy adjustments. So again, there's something to be said about where this sits overall and how exposed people are to this underlying market. So just to look at imports and exports a little bit deeper. So when we look at where things are, exports came in above expectations. The analysts have been warning for that slowdown, didn't really come through, but the imports are telling a bigger story. The argument that Chinese exports would fall was rooted in the idea that as COVID-19 restrictions are lifted, overseas household spending habits would shift from consumer goods back to services. High case rates mean that consumers are still nervy about leisure activities. Again, not seeing that, which is happening. Surplus savings are still being funneled into goods. While overseas demand is still strong, the import data painted a less positive picture. And the other caveat, imports were boosted by purchases of fuel. So when you look at what's happening with coal imports nearly doubled, and they still missed imports, to give you an idea of just how low those are. So imports of commodities used in construction painted a more worrying picture of domestic economic activity. Iron ore imports fell 14% year over year. With real estate sputtering and new wave of COVID-19 cases threatening an already weak consumer sector, the economy is becoming increasingly reliant on exports, which means that there's more pressure there. But with that being said, so the good news is among a dozen provinces that curbed energy use to tackle the power shortages have eased and supply and demand in the network have reached equilibrium. State grid supplies electricity power in 26 out of China's 31 provinces and regions. So you're starting to see some of this get a bit better on the electricity side as they head into winter, which again is a net positive. Now, the U.S. and China is expected. There's some rumors that Biden and Xi will speak next week, but it's important to look at what are some of the impacts. So Chinese and U.S. digital trade priorities make a future international agreement unlikely, given where people sit. And so when you look at the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, Domestic computing facilities as a condition of trade, not compatible. Disclosure of source code, again, China won't do it. And that's a no-go in a lot of these key areas except for regional comprehension economic partnership. So that just means that obviously the U.S. isn't regional. So there's an issue there in terms of where some of that is going to go. U.S. priorities, digital platform not liable for third-party content. That's compatible for most in terms, especially the United States, Mexico, Canada agreement. Digital service taxes do not discriminate against U.S. firms, which fits into pretty much all of them. It's just a matter of where China sits and the control they want to maintain, which is why it's very unlikely we get some sort of deal. But there's a bigger caveat within that. So good housekeeping provisions are basic and generally uncontroversial provisions. They're critical for efficient digital trade. The core good housekeeping features include the following. Customs duties, fees, or other charges should not be imposed on electronic transmissions. Digital products should not be subject to discriminatory treatment. Electronic signatures and authentication should be enabled. The authorities should accept paperless trade documentation. All of that makes perfect sense, but all 6 existing digital agreements include these provisions, but national security can be invoked to override them. And what do we know China would love to do and has done? It's invoke national security, which is why there's such a fear of how do they mitigate against some of that when they're looking, which is why a trade deal is very unlikely to materialize, at least in the next few months. So now when we look at China has loaned nearly $1 trillion overseas. So that's where, when you think about how many reserves are sitting in the system, about 3.8 trillion, 1 trillion is overseas. In the first segment we talked about, or in the geopolitical segment, we talked about how much they've invested in Africa and where some of those fears can come through about actually realizing that, and not only just realizing some sort of interest payment, but principal, and really moving that forward. So then when you look at dwindling demand, Asian dollar bond orders fall as China property woes spread. Because why would you subscribe to all of this subscription ratio for notes sold in Asia, excluding Japan? There is this growing concern that obviously this Chinese problem will expand out. So there's a dwindling demand to participate in some of them. But when we look at Chinese backdrop, so China exports remain fairly at this level. PMI new export orders still remain fairly are that weakness that we've talked about. They're below 50, so you're seeing it actually slow. But then the China NBS PMI new export orders at 46.6 is where we see that problem, which is why we think that, again, that global trade comes under pressure and you see that get pulled down. And as China relies more and more on exports, that's where we see some of those additional pressures coming through. So on a 2-year basis, imports recorded a 12.4% gain, slowing from September of 15.5%. The lower year earlier base and rising commodity prices likely contributed to the rebound in import growth. Even so, import growth undershot estimates, suggesting domestic demand stayed weak. Reflecting relatively stronger exports, China trade surplus rose to a record of $84.5 billion from $66.8 billion, but yet a lot of that money is missing when you look at how it converts into reserves. So again, there's something to be said about where is that money getting funneled into, and then you look at Evergrande's payment being made, and we get an idea. So just looking at this a bit deeper in terms of China trade exports, where they sit right now, sitting at that flattening level, but import trade continued to weaken. Again, a lower high. We're seeing those new export orders come down in contraction, leading to some of that additional pressure. But then when you look at that trade, so the surging trade, so dollar inflows have supported China's currency this year and added to the government's reserves of foreign exchange, which rose to that $3.22 trillion. The dollars offer China an important cushion against future shocks in the world economy, even as individuals, companies struggle. But you're starting to see the imports slow, you're starting to see exports slow, and the pressure's growing because now they're starting to find out there's more debt than they expected, which I don't think is overly surprising, especially when you look at the WMP products or the wealth management products, which we'll talk about in a bit more detail. but exports on that tear, but you're starting to see them crest. And that's when you start looking at where they're going into. The U.S. is coming down, European Union and the ASEAN, which is going to be something to watch when we look at, because China right now needs some wins and they need to offset that GDP slowdown going into year end, and they may try to do something more on the export side. But when you look at China CPI starting to peak up, and then when you look at China PPI going back through 2001, and we know that PPI is the highest going back to the 1990s, that is the problem. How are you going to pass on that cost increase? Because if you pass it off into the international market, people won't buy as much. And if you pass it on internally, people won't buy as much. So you're stuck with how are they going to manage this pushing through these prices as manufacturing gate prices reach these new highs. So Chinese manufacturers are not yet exporting inflation. They are to a point, but you can see the disconnect, and that's where China is trying to give through rebates and benefits and trying to offset so that they can be competitive in the international market because they need exports. Exports is the only thing that has some sort of brightness to it outside of, because they're having issues everywhere else. So this is something that offers up some sort of opportunity, but there's only so much price they can absorb, and that's starting to reach a crescendo. As price changes in 70 major cities, when you look at, you're starting to see decreases in some of these cities as this stuff, prices come on. So that should help mitigate some of that CPI calculation, but price of your food. So wholesale vegetable prices in China shot up this month, and you're starting to see food prices continue to drift higher. But you're also seeing China credit and fiscal impulses becoming this drag. So when you look at total, fiscal and credit is that net problem where credit impulses, and when you look at fiscal impulses, as they continue to try to protect, you're creating this overarching drag that is going to continue through the system. All the while, PPI raw materials year over year, new all-time high based going back to 2001. And the China PPI-CPI spread back to all-time highs, taking out the highs from 1997. So you're going to have to adjust somehow, but again, it's going to be in a way that tries to not hurt the export side while not also hurting the the consumer, which then falls on the government eating this cost. So on the other side, we have thermal coal futures coming down again. According to the NDRC, coal stocks at key power plants exceed 120 million. China's coal output has quickly rebounded after a cold wave hit major coal production provinces. Coal stocks at the nation's key power plants has exceeded 120 million, increasing more than 12 million tons from end of October. Coal stock is now enough for use for 21 days. Energy supply shortages has been eased. So there's some, congruency with what we're seeing across the different metrics. But only a few provinces in China are still contending with major power outages. China's largest grid operator confirmed Sunday that supply and demand have returned to balance. China's daily coal output has risen by more than 1 million tons in recent weeks to about 11.89 million tons and is expected to soon surpass a government target for production of 12 million tons a day. The ramp up is exceeding expectations. And then on the other side, coal inventories at India power stations are up 50% from the lows last month. State Grid Corp of China, which supplies power to about 1.1 billion, said coal inventories have rebounded. And then again, finishing up on the Indian side, coal inventories at India power stations rose to 12.4 million tons on Friday from the low last month of 7.2. Major industrial consumers who had coal supply limited as authorities prioritize power stations are also seeing conditions improve. So on both the Indian and Chinese side, you're starting to see some normalization of activity, again, weakening or at least softening some of the need for some of that coal to gas, that gas to oil switching. So, and when you look at China real estate, corporate U.S. bonds, and then world material equity indexes, you get an idea of where the pressure resides and how we expect to see some of this get pulled lower, just given where China is, where their activity is, and how we don't see much really happening over the next few months. All the while, China's producer and consumer price inflation both shot up in October, with the gap between the two widening even further. High-frequency data, government controls on energy use are fueling gains in material prices. So when we look at just where the level of inflation is, you can see most of these things are either getting hotter, are hot, or are going to continue to become a much bigger issue, with leading indicators such as the input and output price sub-indexes and the official PMI data both jumped in October from already lofty levels, pointing to stronger upward pressure on PPI inflation. At the downstream end, year-on-year declines in food prices are poised to narrow thanks to smaller fall in pork prices and a big spike in vegetables, combined with further gains in some non-food prices, including transportation and recreation, should continue to lift CPI inflation, as we talked about with others. PPI inflation to accelerate further year on year, and again, we're continuing to see this move up in general. So factory inflation continues to rise faster than CPI, which is also picked up. But this is when you look at China had a total of 27.952 trillion yuan, or $4.3 trillion of outstanding wealth management products at the end of September, up 9.3% year over year. So in Q3, China saw 9.88 million new wealth management product investors, with 11,700 new WMPs issued, raising 31.9 trillion yuan. So who are they borrowing from? And the question remains now, how exposed are consumers? Are they now more exposed? Is this becoming a bigger issue as that exposure gets passed on? Because banks have been struggling to finance. Real estate companies have been struggling to finance because banks have said no, which has led them into shadow banking, and now more to the consumer, which is a growing issue for the government that is trying to protect the consumer overall. So then when we look at the U.S. credit yield, you can see this huge surge as China's real estate scenery journey Evergrande unit coupons due November 6th may have entered grace period. CASA puts up 13 billion worth of projects for sale. Thank you to spin-off property management arm. Yango extends November 19th note by a year. Shimao yuan bond slums 34%. China's 25 major machinery makers sold a total of 18,964 units of excavators in October, down 30.6% year over year. That included 12,608 units sold domestically, sliding 47.2%. And 6,000 units exported, surging 84.8%. So it just shows that activity is getting hit across the board. Construction, everything is slowing overall. So then when you look at Evergrande effect, China's dollar junk bonds continue to push to the highest in at least a decade. But here's where the offshore side is peak stress level. We know the credit stress level, but the stress still remains mediocre onshore. And our issue is we believe that's wrong. And the reason why is because of the WMP exposure and that wealth management product that really is not being tracked as closely. And now that they're tracking it more and more, you're seeing that the exposure is much bigger than I think what expectations were. But what is China trying to do? Now they're trying to reignite infrastructure. So what do we need to look at? The SPBs, the special purpose bonds, and the LGFVs, or the local government financial vehicles, to see how much of this is being pumped into infrastructure system. Right now, local governments and provinces are choking on the previous investments as tax revenue is going to pay interest plus principal. Many areas are struggling with low tax revenue. So the onshore side, I think, is a bit misleading. But things to look at going forward, it's the triple today with Evergrande. But what do we have going forward? So the grace period ends November 10th, as we know that they've paid. They have more December 6th, and then more on January 27th in terms of when we assume that they're going to enter into that grace period. So at the heart of the bond market rout is concern that developers may have far more debt than disclosed in their balance sheets. That's after some companies struggled to pay their public and hidden debt despite appearing to have sufficient capital. Making matters worse is developers' inability to roll over maturing debt due to surging borrowing costs. China's 10 largest developers Developers by sales owe a combined $1.65 trillion in liabilities. So you're getting an idea of how those the cash cushion that they have, or that China has at PBOC, which, they have reserve currencies of 3.2 trillion, but then when you factor in all the banks, they're closer to 5.6 trillion. You get an idea of how quickly that goes away based on these exposures. And the stakes are high. Chinese banks had more than 51.4 trillion yuan, or $8 trillion of outstanding loans to the real estate sector as of September, an increase of 7.6% from a year earlier. So you're getting an idea of just how big this system is, and where the pressure can really go, and why it's so important to not only China but the rest of the world. The exposure was more than any other industry and accounted for about 27% of the nation's total lending, according to official data. About 41% of China's banking system assets were either directly or indirectly associated with the property sector at the end of last year. I mean, if that doesn't scream potential contagion, I don't know what does. So China's macro policies are remain tight. Infrastructure investment is the one that they're trying to adjust as government expenditures remain muted. But we do expect to see some infrastructure investment turning back up. And they're going to be doing it through, as we said, those SPBs and the LGFVs. Infrastructure is the foundation, and this is quotes from where things are coming from. So infrastructure is the foundation and guarantee for economic and social development, and has a strategic, basic, and leading role. Promoting the steady growth of infrastructure investment is of great significance to effectively hedge the downward pressure of the economy. According to data released by the National Bureau of Statistics, in the first 3 quarters of the year, country's infrastructure investment increased 1.5% year on year, and the 2-year average growth rate was 0.4%, an increase of 0.2% from January to August. Although compared with the growth of fixed asset investment and manufacturing investment, the growth of infrastructure investment is still weak, but a comprehensive analysis, again, they're trying to drive this back through. The accelerated implementation of major projects has provided strong support for the steady growth. According to statistics from the National Development and Reform Commission, in the first 3 quarters of this year, a total of 66 fixed asset investment projects were approved, mainly in the fields of transportation, energy, and IT. At the time, the 102 major projects specified in the 14th five-year plan are being implemented. In September, a total of 6,646 major projects were started in 23 provinces. So again, how much you can add to that, given where they sit, the pressure they have, the fact that there's not enough revenue to really go around, and how they've really invested poorly over the last several years, makes it difficult to see this be a real answer, especially as you have more pressure with these. These are China's 2 biggest property developers, Country Garden and Vanke. Dollar bonds are starting to fall. That changes the stakes for authorities. Again, looking at how are they going to try to mitigate this if they're going to need additional cash to solidify these problems. As the sharp property downturn is the biggest risk for growth. And as we've talked about, like, we're seeing drops in everything: construction, real estate, agriculture and industry. You're seeing exports being kind of the last bastion of strength as consumer sales, consumer spending continues to go through a floor. And this is just looking at the Casa dollar bonds tumble amid growing concerns over its financial health. So you're getting an idea of just, again, consistent selling, consistent pressure, which didn't help with the Evergrande news. And this is just another round of the Ion group and the Sunac China Holdings. You can see just moving and really pennies on the dollar. Now, shifting gears a bit to Japan, when we look at what is happening right here, household spending surprised to the upside, was expected to be down 3.5%, came in at negative 1.9%. Leading index right in line with expectations, coincident index right in line with expectations. And then when you look at bank lending, getting a bit better, economic watcher survey was expected at 48.5, came in at 55.5. The watchers survey outlook was expected at 57, came in at 57.5. So things, when you look at what leading indicators, where things are going, Japan's getting a bit better. but household spending still remains very much lackluster. So they're still relying more on the export side, more on the industrial side. Toyota's gotten a bit better. Nissan's gotten a bit better. So you're starting to see some of the shakeup and some of the benefits in terms of where these growth is coming from, and Toyota turning around will be a large benefit. Then when you look at India's service PMI, blowing through estimates, seeing strong growth coming at 58.4. But as we talked about in the EIA show, diesel demand is still very low and down to an 8-month low compared to year over year, which is, again, that underlying problem of how healthy is that economy. And then when you look at Korea, prices continue to surge higher, which, again, just supports more reasons for a rate increase. So I know we covered a lot in this segment and in just the economy show in general. If you have any questions, you can find us in the comments section. You can find us obviously on Twitter. We appreciate hearing from you. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.